Welcome to The Truth About Ag. Welcome to the Truth About Ag podcast, distributed under the Real Ag Media Network and powered by the Hebert Group of Companies. Remember to like, share, comment, and subscribe wherever you get your podcasts. So we're going to do an interesting one today. So we got a friend of the let's say friend of the family on today. So I'm going to let Ben kind of give his intro to him, and then we're going to also give our intro because this one's going to get pushed out into the U.S. a little more as well, as Ben works for Fractal down in the U.S. Take it away, sir.
Yeah, it's good to chat again. And I guess I can't claim to be that much more American, given that that family homestead, I think, is less than 100 miles south of you guys. I'd be 120. And so I think the accent's going to come back. But yeah, Ben Gordon, CEO, co-founder of Fractal Agriculture. Some would say we're a farmland investor. We say we're a farm capital provider, and specifically equity capital. But I think today we want to talk about a lot of the high level things that we see in relation to what you all are doing.
So we'll give a little intro for us. So Heebs, I'll let you go first.
Yeah, so I'm Kristjan Hebert. Main operation is a grain and oilseed farm in southeast Saskatchewan. Ben's right, we're only about 60 miles from the American border. Canola, wheat, mull barley, yellow peas, fall rye. Have a few other pastimes. So obviously co-founder of Maverick Ag and the Truth About Ag podcast with Evan, who is my partner in those and the CFO on the farm, and then kind of have dabbled a fair bit in business risk management, in policy type work of hopefully helping to guide a little bit of where it goes, and mostly probably spend most of my spare time coaching a 10 and 12-year-old playing hockey.
Yeah, so since he kind of gave my intro anyway, I'm Evan Shout, CFO of Hebert Group, as well as co-founder of Maverick Ag and Farmer Coach. So we run a CFO consulting group in Canada as well as the US, and then we run a coaching program that kind of falls into Western Canada and into the northern US states. So
Nice. Well, I think I first met Kristjan in 2018. And so I think I got a very unfair look where I got to look at your data before we had a conversation. We're going to come back around to a lot of what you guys do and how you address a lot of the things we're going to talk about. But I want to start with kind of the macro environment for agriculture. And this isn't going to be some grain marketing macro. This isn't talking about what you need to be doing in the next 2 years to make sure you're properly hedged or where prices are going. Like, we want to talk longer time horizon. We're talking 10, 15, 20 years. And what are the trends that we have to engage with now versus maybe we just can't control them, to use one of Evan's favorite pet peeves on here about what's controllable or not. But maybe where I'd start off is, why, especially if I'm somebody, I know a lot of your Canadian folks are going to get this, but especially we bring some folks down to the States. I've always had a thesis that Saskatchewan in particular is a little bit further ahead because of some unique dynamics that you guys have that it essentially made your market scale, where scale mattered more early. And so where I think we're starting to hit that more for a lot of things I'm sure we'll talk about in the States. I guess maybe give us the quick pitch. Maybe I'll start with you, Kristjan. Like, why if I'm an Iowa or Illinois, corn and bean guy, should I be talking to a couple of Canadians about macro? And like, what is your market look like over the last 10, 20 years?
Yeah, so I mean, I think there's a couple big points, right? Is that we maybe spent a fair bit of time realizing early that we had two different business, right? A real estate business and an operating business. And we needed to scale for both of those reasons. But the OpCo one kind of has to scale first to pay for the real estate addiction that most of us have as farmers. But over the last 100 years, whether you're in Saskatchewan, Canada, or anywhere in the US, that addiction is actually paid pretty well in equity value and access to capital if you can lever against it. We've had a couple things. One would be, selfishly, our land ownership rules are pretty tight, specifically in Saskatchewan, but in Canada also compared to the US. So it's kept land a lot closer to what let's call productive values versus just a real estate investment. I think that's allowed it. I think secondly, I mean, we're not blessed with quite as much black dirt as the Midwest, right? So 4 to 6, maybe 8 inches of black dirt is more Western Canada, depending if you get it in the Red River Valley or the Peace, that would be better. But it's forced us to our margins on every individual acre aren't quite as strong. So you needed more acres, which then tied pretty well to obviously what they were doing with equipment and technology, right? Is that, that my grandpa could only do 40 or 50 acres with a horse and a plow, but we can do 100 to 110 acres a foot with a 90-foot air seeder running 24 hours, with the kind of the same people. So we just kind of came in early that we needed about one full-time person for every 2,500 acres. We should seed about 100 acres for every foot of whether that be an air seed or a planter, and started to realize that those fixed cost efficiency metrics allowed us to scale and invest not only in land, but in people. And that's probably what drove us to chase it pretty quick, right?
Yeah, absolutely. Evan, what would you add, especially when you look at, I know you were just down at TPAP and you talked a lot in one of your previous podcasts reflecting there. I guess, what are some of the other differences that you see, because you spend a lot of time there?
Yeah, and I think part of it is, if you look back, and we always say this in a lot of the courses, is land was overpriced 10 years ago, land was overpriced 5 years ago, land is still overpriced in terms of if you want to look at it from that perspective. But the other side of it kind of tied down to the guys who determined they were going to take on risk early in their careers, such as Kristjan and such as a whole bunch of the other farmers we work with. It was a timing issue more than anything, Ben, to tell you the truth. And I'd like to say everybody had a plan, and the guys who thought it out better just got ahead, but it was strictly the guys that wanted to take on risk and were a little more aggressive, a decade or 2 decades ago. They just timed it right. And you're right, land 10X'd, and it worked out as the real estate side of the business really took that jump. But a lot of it was timing. And I can tell you to follow that roadmap going forward, but that roadmap is really hard to follow these days when the price is considerably higher. And I don't think we're going to see that same jump. So it's going to come down to business sense now versus in the past. I think it was a timing and a risk standpoint. Now we're actually going to have to learn how to farm and honestly really push those parameters in order to make the tighter margins and the cost of land actually pencil out.
All right, so there's a bunch of different directions we're going to go. I think one of the things that I want to really push us all to do is go beyond that high level number. So couple of third rails that I want to hit here. Is land overpriced or not? So I think we'll hit that one. Does scale really freaking matter? Or are we actually just saying hey, it matters for you guys, but what do we think that looks like for other parts of the ag economy, especially where margins have been higher per acre? But maybe what's happening there. But maybe actually let's go to the first one. Land overvalued, whether you're in Saskatchewan or Black Dirt in Iowa. Which one of you wants to take that?
Good. Well, I think the big thing is what type of an asset do we think land's going to be, right? So if it was just purely on a productive value, yeah, it's overvalued. But you take gold or the stock market, it's partially has a valuation based on safety. And I think you can argue now, under the current administration, we may see Bitcoin take over, even gold is a safe haven asset. Now, whether we'll get there or not, who knows? But why are people talking about it? It has a limited supply. What else sounds like that? Land, right? So that'll be the big question is do we feel that land is always going to be a safety investment? And do we feel that regulations are going to get tighter around the ownership of land or loosen around the ownership of land? And I don't believe it's tighter in the world we're going into. So if people need a place to store wealth, right, that they feel is safe, that means that land doesn't always have to tie to productive value. It ties to its value as an investment and its long-term appreciation. So now it's, as farmers, obviously I still love buying land. I'm going to buy what I can. But I also realize I don't need to own every acre to operate the ones I want. And secondly, I think the big thing is we probably need to start to have some really good conversations with some of the wealth groups that are buying, that the cash rate of return is what needs to be tied to the productive value, because they're looking at the long-term cash and appreciation value. And if we can get that matrix figured out, I think the people that figured out are going to continue to scale and invest in their business, and the ones that don't aren't going to do it.
Well, and I want to add to that, Ben. I think, we always make the joke is the farmer goes and sells his land and goes into the financial advisor and says, what should I invest in? And the answer is land. So if we look at it from that standpoint, just to piggyback what Kristjan said, it's going to come down to the next few years, and it's going to come down to the fact that rental is going to be required. You can't buy every acre. You have to be comfortable with the mix of and know your metrics of how many quarters you got to rent versus buy, because that's what we're starting to have, those type of conversations of you're not going to be able to buy every acre, and honestly we don't have enough capital in Western Canada to buy the amount of acres that I believe are going to come up as the baby boomer generation moves and as things transition, because the next generation is much smaller than the one that's leaving. So that's kind of the one starting point. And from then on, I mean, it's still got a pencil. And I mean, from a real estate standpoint in Canada, we're still at the point where from a real estate return, it out pencils the debt serviceability on the farm. So you might take a hit on the farm, but you're going to see the appreciation on the land make up for it. And whether that continues, that's give me a 2020 vision. I'd let you know, but at this point it still does. And I think that's where guys have to start looking, is they're making a decision based on the well-being of the farm as one entity. And as Kristjan said, you have two entities, and we need to start looking at the real estate return versus the cost to the farm, because they are two totally separate entities, and it might make sense on one side and not the other. You have to know which one is higher.
Well, I think that it's a good point when we say pencil, right? Is that sometimes I think as farmers we forget, and I mean, and I'm no different than most. I have a lot of debt, right? I have to service it, but that doesn't mean that every farm has to take out a loan. Some farms can just pay cash, and some investors can just pay cash. And so it's also to remember when you're penciling, there are different ways to your cash flow is not everybody else's cash flow, right? And there's a difference on looking on the cash flow side of an asset versus the long-term investment side of the asset. And as farms, have better years and put together wealth, is land where they want to store some of that wealth and just write checks for it. Because there's a difference in when you just buy it versus if you have to take out a 20 or 30 or 40-year loan for it too, right?
And I think, sorry, Ben, I think we've been having that discussion a little more of, like, you don't know the cash position of the guys around you. So when you're making bets that the land's overpriced, you can't afford it, why are the neighbors doing that? It's a dumb decision. Your position is not the same as theirs. And if they're throwing cash down because it's a real estate investment and it's not actually increasing the interest costs on the farm, it may actually pencil. And then all of a sudden, you're wondering why the cash values are going up on land. Well, we've had some pretty good years in Canada, especially, and I know in the US up until the last couple, there's a lot of wealth in ag that wasn't there before. And we get asked a lot if, we're looking at the 80s where we're going to see a dip and things are going to go down. And it's like, I have a hard time believing it, and it could happen. But in my eyes, there is more wealth and cash flow in agriculture today than I have ever seen in my 20-some years of being around this.
So we talk about a lot of different things. I actually want to tie a couple of them together. Yep. So one is we've talked about, all right, so where land values at, but we reference, or Kristjan, you referenced like scale and where does that go from a competition standpoint. I'd argue there's a direct tie there. And the third thing I want to bring here is asset heavy or asset light. And what does this mean? And so one thing I will be curious to see where it works for you guys, but I think one thing that is distinctly different, especially in a market like Iowa or Illinois, is that you're seeing the professionalization of land management. Not just investor owners, but the majority of absentee land that was probably 2, 3, 4 generations removed from being a farmer, him or herself, right, is now managed by somebody who has a duty to get that maximum marginal rent. You combine that with slightly more scale and operations and folks expanding their operating base due to technology and other just efficiencies that they have. Now you have more competition. And so one thing that we've seen, and I'm curious if this is like that in your guys' area, there's a unique element to your market. But you look at rental auctions, custom farming being much more common, and just transparency to what that marginal rent of that top, that top performing operator is out there. I would make an argument that renting margins are likely to decline unless you have a unique relationship with that landowner. On any of that resonate or differ in your neck of the woods?
Yeah, I mean, the one pretty awesome thing for us is we get to learn from you guys, because I would say, the majority of people that are renting land are either renting land to us and to Canadian farms, are at most kind of one generation away from operating the farm, and some of them it's actually just the farm itself is just slowing down. But I don't disagree that you're going to find areas where if you want to rent land and have the margin on the rented land be, similar to what you own, you're going to have to find unique ways to do that. Things as simple as paying land rent monthly versus once or twice a year to take risk away. And the different types of things you're going to do versus somebody else, because just doing it the same as everybody else is 100%. It's going to end up in an auction. It's going to end up the highest cash bid. And I mean, even things like we started sharing soil tests, et cetera, to show that we're going to treat your rented land exactly the same as our own land and show you that it's improving in quality and value every year. Because I did start to see that trend of highest rent and kind of the custom work mentality. But I also am starting to see a trend in these professional type mindsets, as you said, that they do understand land getting pillaged and all the nutrients being used for 5 years and then the person moving on. So I think there's a nuance there that we can work together with that professional type mindset person that wants to rent the land out, with those of us that, pay on time and take good care of the land too. But if we don't talk about it and pitch that, then I'll tell you what, the top cash return is going to win every time.
Well, and I think, I mean, and I learned this from Kristjan, actually, to tell you the truth, is most guys just don't ask what they want. Like, have you ever had the conversation with the farmer himself of, I know you want high top dollar, don't get me wrong, that's a pretty simple one, but what else is there? I mean, do you have tax issues? Is there, are you looking for the monthly payments? Those kind of discussions, they almost give you the negotiating power by telling you what they want. Because a lot of times, a lot of stuff that you can provide, aka we do a lot of tax planning for a lot of our renters, because for us, yeah, it's a cost on professional fees, but compared to what we'd be paying in additional rent, it's a pretty easy saving. And I mean, we got 2 CPAs here, so it's easy to say to do it, but everybody has an accountant, most likely, or a tax account. These kind of philosophies and plans and being ahead of the other renters that you're competing against, it's just those little things. Like, it's not, the difference between getting it and not getting is not going to be a huge difference if you have those little things in place.
All right, so I'm gonna push you guys. You have a great relationship. You're one generation off. But let's say it's somebody you have a fantastic partnership with and is a relatively big chunk of your portfolio. And Kristjan, I heard you talk about ratios before. We were talking about fixed cost coverage. Well, you have a professional land manager who comes in, and they either want top dollar, which you're probably well positioned to pay if you have to on that, just given who you guys are. But let's say they're also creating their own operating company to come in as well in an area, and so there's just nothing you can really do on that. Is that manageable risk or not? And how does that fit into your equation of owned versus rented assets over time?
Yeah, I mean, it'd be an easy discussion for me. Like, if they want top dollar, then you got to share in some risk with me, right? So we have some variable rents that show a bottom side dollar, and then they have a cap on the top. And the more money I make, the more money you make. And if that doesn't work to hit top dollar, then take your land and farm it yourself. Go right ahead. And I wish you all the luck watching me kick your ass will be the attitude, because we're great partners when we're partners. But don't get me wrong, we love sports and we're going to find a way to win. So, and that I'm pretty, I maybe haven't shown this side too much on the podcast, but I'm pretty honest about that part, is that when we're partners, we'll do everything we can to work with you. We treat you like good business partners, right? But if you're going to pivot and try to pivot from a partner to a competitor, then that's the way we're going to treat it, is we're in this game to win, and we're going to use everything we can in our power of, guess what, every person you're going to bring your opco in, we're going to start talking to everybody about, we are the local ones. And we got 40 kids at our Christmas party that go to school in the local schools. And oh, by the way, we donated to the airport. What's Walmart done for you there lately? And I probably start nicknaming some of the professional operators of Walmart. And people aren't going to want to hear that. But I also don't think you can get so tied to a block of land that it can wipe out your operating cash flow. So could we pay it? Yeah. But I go back to the old Detroit Red Wings. Could they have paid Nicholas Lidstrom more? Yes. But when the young guys came in to try and make $1 million more than Lidstrom, guess what management said? Why do you deserve more than Nicholas Lidstrom? So when you're negotiating those deals, you always have to remember where all your other deals are. And could you overpay for that one? Yeah, you could. But then how are your morals and your business ethics with everybody else you deal with? Because is their land worse? And is it a short term or a long term play? So we really tried to take the long term view on our land. And would we like to drop a big chunk? No, but that's why most of our equipment deals are set up the way they are. We could peel off equipment if we had to. And it's also why we have most of our land get renegotiated a year before the contract's done, so that it's not a surprise when the time comes and we can plan for it. But for us to just stretch way up one time for a professional operator because they think they're going to lever me with an opco, they'd be dreaming, to be honest. I don't know if that's the answer you're looking for, but
to be fair, Ben, I love when his filter goes out, because you're getting the true answer here, and it is. I mean, from our standpoint, it's got a pencil, and I mean, is every farm going to treat it like this? No. you're going to have some guys that just go to the world, but I'm going to promise you that we know our numbers and we know where our breaking points are. And like you said, I mean, it really hurts your reputation when you have a whole bunch of really good renters with really good land and they're getting underpaid because you went and paid more for something else. The other aspect is we've built our machinery plan in such a way that we can move very quickly depending if we gain or lose land. And it's all based on efficiencies. And I think that's one of the misconceptions. And I know in Canada for sure, US, I'm not 100% positive then, but we have our LPM set so we can take on extra acres and it'll actually drop our cost of production, even with some higher priced land rent. So a lot of guys look and say, well, you pay too much. Your cost of production is too high, you know. But from our standpoint, if you can stretch machinery and drop your LPM numbers, your labor power machinery numbers, and in turn, that drives your land building finance numbers up a little bit, you're still in the same position from a cost of production standpoint. So it's a bit of a different conversation than just the land suit price. There's other factors at play. I want to take this moment to give you a little highlight on one of our sponsors, Maverick Ag Consulting, providing the link between primary producer agriculture and the business world. Maverick offers specialized financial and operational consulting products that allow farmers to navigate the current farming environments. Looking to take on more dirt, an expansion in equipment, or just lay down a strategic plan for the farm? Maverick provides you with specialized resources and tools to take the gut check and emotion out of decision making. If you are ready to take the next step in your farm's definition of success, reach out to maverickag.com for more details. And back to the truth about ag.
So Kristjan, you expect me to be looking for an easy answer of like, oh no, that's super risky to the business. No, you're actually making the exact point, which is like the competitive point is the risk management plan, and it's the forward looking. I think it's a lot easier to say when you're managing, a ton of acres versus, we've had a bunch of situations where often it's an incoming farmer next gen. They've maybe taken over for, we'll say 2 to 5 years. They've already started implementing some good changes. They know they need to scale. And they have one landlord, maybe it's an extended family member, who has 25% of their or 30% of their rented base. And for some reason, often it's professional management or it's the confluence of several different things that comes in and says like, hey, this is what we could get. You have 90 days to go solve this. And, before we hopped on, like, I'll get on Evan's soapbox for him, like have a plan for that and like be proactive on that. That is not an uncontrollable risk. But I think like there's real changes, and this is where it's like that entire operating system kind of comes together. And in this conversation, we're not going to like perfectly frame it out. And like there's just so much that goes into it. But I do think just like hitting this competition, like why are some folks able to pay more on that? I think is a really important thing for us to just like say out loud. Everyone wants to talk BTOs and all this stuff, and like nobody talks about this stuff explicitly, and it drives me nuts. So can we just talk about what are the benefits of scale? And I'll give you a little bit of the North American view, like where it goes. And like, I want to get into like, what are the levers, right? Let's put on the old consulting hats. We got procurement, operational efficiencies, coverage of fixed costs. What else? Like, let's break it out. Like, where do you guys want to start?
Well, I mean, I was just out in Ottawa for 3 days of meetings and conferences, and I literally must have had this conversation 100 times because the first thing that comes up is, Kristjan, you're 40,000 acres. Is that, how exactly does that fit on what agriculture should do? And I'm like, yeah, but like my dad put in his first crop on his own land in 1978 on 320 acres, right? By the year 2000, we were 3,500. And even you go back 10 years, we were like 11,000 or 8,000. I'd have to look at the exact number. Jeff's been here 8 though. And I think he came in at 11,000 or 10 and a half. So, I mean, I've been where these young guys were. Like when I was 25 years old, we were 4,000 acres. When I was 30 years old or 35 years old, we were 10,000, right? And really, I think you have to have your reasons on why you do it. And everyone's will be a little different. I had 2. Number one, I wanted a farm that could manage itself. And there was no way for me to have good enough people to do that at small acres. I couldn't have a mechanic at small acres that could be a mechanic 80% of the time and farm 20%. And I couldn't have a COO or a CFO or any of that, right? So that was point number one. And I wanted to coach my kids' sports, and my kids are 10 and 12 right now, and I needed it done by about this age. The other one was I didn't want everyone I have to deal with to be able to take advantage of us. So in that case of your young farm, if somebody has 30 to 40% of your block and your block's barely big enough, for your family to survive on already, that's too much power in my mind. And same thing with John Deere. If I'm only buying one combine, they have the power. At my local retail, if I'm 1% of their business, they have too much power. But the thing is, you don't need to be 100% of their business. So when I go to the retail, if I'm 35% of their business, now I've put the retail in the same position that your young farmer's in. Because a 35% decrease in your business all of a sudden takes you from making money to breaking even, right? Same thing with, the local Deere dealership. If I'm trading 25 pieces instead of 3 pieces, there's enough margin there that it counts. And so now we're on in what I call an even playing field in negotiation. When it comes to how do we operate, you're right. Scale was the other piece that helped us figure out how to sharpen our pencils more. But I wouldn't say there's been unintended consequences of scale, but whether we were 8,000, 16, 24, 32, or 40, our fixed cost management can be almost perfect. Our fixed cost ties super high to multiples. But we'll see fixed costs vary by $100+ an acre. So if we're pulling in right beside a neighbor that has bad fixed cost management and they cost $250 in labor, power, machinery, and I cost $150, well, that means I can pay $99.99 more for land rent that they can. We make the same money at the end of the day. And that's assuming that we have the same yield and the same marketing, right? But that's just in fixed costs. So we'll see 50 to $100 an acre spreads there. And then on top of that, it's who buys the best. And part of that is scale, but part of that is timing, right? Mm-hmm. So we found with scale, we can negotiate with retails a lot more on timing. I can book and maybe not even pay till they get the product in 6 or 9 months later, because we're a big enough account that's the deal they'll give us. Well, timing on input purchasing has a lot to do with cash flow and your logistics, right? And then marketing. This one was really one that, I've done a lot of business in the U.S. The American farmer does a lot more hedging, options, puts, et cetera, than the Canadian farm. I'll give him credit there. But in Canada, it's not something that's really done a lot. And it was an unintended consequence as we scaled, is that it forced me to look at markets way more and get Jeff and Evan more involved. Because, we got right around 2,000 loads of Super Bees of grain that got to go out every year, right? We get 600 of incoming input. So, we need a pile of trucks on the road every day of the week that we're not seeding or harvesting. So it forced me to start making sure we had time slots, et cetera, booked all the time. But then if I don't like that price, dealing with markets. But the kicker is if you cash price everything you sell, you have way more cash around, and I only need to use 10% of that cash to carry it on the market. So now magically, we could recognize our size way before we sell the grain by utilizing hedging strategies and options and puts, right? So those would be the 3 big levers is your marketing plan, your input and logistics plan, and then your fixed cost plan. But the one piece everybody needs to remember is none of those plans actually matter if you don't have good people and you're the one out there doing it all yourself all the time. And that's, if scale is done correctly, growth is your best thing to fix most problems, right? Or if it's, because you have people and it frees up you to do the stuff that actually drives your bottom line. Now, if you scale and you're always understaffed and you're out working every day, you're not doing any of the 3 things that make you the most money, which is fixed cost management, input and logistics management, and marketing. So it's a double-edged sword, right?
Well, and I'll add to that, Ben. I've worked with a lot of farms, and a lot of big farms, a lot of small farms. Big farms can be just as bad. There is a gap between good management and bad management, and scale won't fix that. And as Kristjan said, is if you scale up wrong, you're just asking for more of your time gone, more mistakes. And when the mistakes are made, there's bigger numbers. And then going back to your 2,000 acre farm and then his ability to scale, I think what we're going to have to realize going forward is, and don't hate me for saying this, consolidation has to occur. It's the little thing that nobody wants to say. It's going to occur and it has to occur. So let's get that right out of the way. And now let's have a real discussion on how we can do it. So if the land's overpriced and you're not going to be able to buy land, or it's too competitive and the big guy beside you is buying everything, there's going to have to be collaboration. And I'm not saying that means farm and farm collaboration. I'm saying the generation moving out. If land's still a good investment, keep the land to yourself, join in a venture with the young guys, get them involved, get them more acres. Collaboration has to sustain throughout. And we see it in other industries all the time. And I think part of farming is we're really rugged individualists. Everybody wants, I want to be in charge of everything. I want a micromanagement. I do the best on my acres. I'm competing against my neighbors. And I think we're going to have to change that mentality. And at the beginning, you said, that 10 to 20 years, this is where agriculture's got to move, because scale, as Kristjan said, gets us the power on the procurement, power on the financing. You're gaining some of that power back against the industry that has already consolidated against us. So if you want to take some of that power back, you're going to have to start working with other farms to get scale, even if you're separated, but you're one big buying group or one big purchasing group. And whether it's a joint venture, whether it's structured that way, it's totally up to those guys. But that's where agriculture is going to have to go in order to survive this. And guys don't want to hear it. They don't want to say it. And it's fine. We can skirt around it for the next 10 years. But all that's going to happen is the gap between the guys who are really growing fast and the guys who are standing still is just going to get wider and wider.
Mathematically speaking, if you're below essentially the cost of production, you're subsidizing that in some way that you probably don't, because you don't know your books well enough, you are actually paying to farm. And I think there are way more folks doing that, and that's only going to increase. I want to put a fine point on a couple of things you said. So we did a little study in Iowa where we essentially went to a bunch of our customers, a bunch of our partners, including some of the input providers. We did an estimate, 2,000 acre corn and bean grower in central Iowa to a 10,000 acre grower. What do you think the cost per acre difference was? You either go percentage basis or nominal dollars. If I include procurement savings on my inputs and I include basis adjustments on delivery, what do you think the range was?
I'm an corn bean. And those are the two big things we're talking about, is input, procurement, and basis.
Yeah, procurement and basis. Yeah. So I'm assuming like similar equipment efficiency. I'm assuming similar agronomy. And it's just literally my purchasing and selling power delta.
6 to 10%, but on a corn and bean farm, that's a lot of dollars per acre. That'd be like, that's my ballpark.
Yeah. Evan, what do you got?
Oh, I'm deferring to his answer because I don't know enough about corn and bean down there to actually make that call.
Yeah, you're pretty much spot on, Kristjan, depending on like where you're at on cost of production. It was essentially $50 to $150, more weighted up towards the 150.
Yeah.
And for folks that knew how to market and had direct relationships, and there's tons of local offtake there to get there. Right. And so if you think about that in a context of the market environment that we're at today, that is not just the difference between being somewhat profitable and not. That is the difference between making that 500 acre rent, even in today's world, especially if you're maximizing your operating efficiency, like that could be a sensible decision. And for anyone who's not in that area, they're just going to be pulling back. And so this is where I think, your competitiveness conversation with that kind of scale conversation comes in. Now, I think we've seen folks where if you have a unique niche, you don't need to have that scale, right? As long as you're at that right efficiency or you coordinate. So it's not just bigger and better. And we made that obvious huge caveat of similar agronomy. And there's a lot of shitty, like if you think about the 2010 strategy of asset light, expand through rent, and go make that happen, it wasn't even procurement savings at that time. It was just logistical savings, right?
Yeah.
And you had some really poor agronomic farmers. I'm not going to call them a poor farmer because I don't sit in those shoes, but like shitty agronomics on where it goes. And I think it's that combination of the two which hits the management that Kristjan was talking about too, and having people.
Well, I think people forget that. So if you use the 10%, right, $1,500 break even or cost of production gets your extra $150 an acre at 10%. People are like, yeah, but that's only 10%. Yeah, but we forgot to tell you that net income on average was only 10%. So it actually was 100% increase in net income, right? And we did the same thing when we were building a private insurance company. We draw a 50-mile circle, and the two big things we check was standard deviation and income. So how consistent they could be. The top three operators in the 50 miles, their standard deviation was way more consistent, and their net income was 200% of the average net income. And we were only looking at people that were incorporated and farming, a minimum of $1 million of revenue. So we're taking out all the other ones. But even within that group, they were more consistent and they always made double. Like Danny Kleinfelter always said, right? One is timing, but two is repetitiveness. And he always used the baseball example, right? Like what's the difference between a 320 hitter and a 400 hitter, other besides a Hall of Fame, $8 or $9 million a year? It's like one more hit every 20 at bats. Yeah. That's it. They weren't crushing an extra home run every 2 at bat. No, every 20 times they went to the plate, compared to the average and the best, one hit. That was the only difference. They just did it for 15 years.
Well, and we're forgetting the other fallout from those. I mean, if your gross margin's consistent, your bankers treat you better, your interest rates are low. Like
Yeah.
you don't realize how much fallout down to fixed costs, your efficiencies on equipment, your finance costs. Like it is just it's a cascading. So if you're already getting that margin on the top end, you're actually going to be less risk. You're going to actually get other margin on the bottom end. So we're talking, 100 to 150. It could end up being 200 or 250. So you don't realize how much that compounding and the 5% actually matters.
Well, let's talk about the compounding in the face of volatility. So listen to the CPOP piece, and I know Mr. Kleinfelder had a lot of comments around crisis management and where that's an opportunity. Let's go back to a little bit of macro. So when I'm pitching farmland to an investor along a coast, it's essentially I'm going to take the recording of this and just have Kristjan do it for me now. But it's, what's the financial value? Well, it's a non-correlated asset that's a safe haven asset. Essentially, it's a hedge that pays you a coupon. Instead of just going gold. I mean, and Buffett said that, but nobody did it. And the reason was, even in the States where we have much more liberal laws than what you guys have, nobody's been able to scale because it's an incredibly fragmented asset class. Well, as we see the generational transition that we're talking about, and I heard your Dr. Cole's 2033 number, and it scares the hell out of me, where the actuarial age of death and the ownership age kind of overlap. We're going to have an unprecedented amount of land coming available as scale advantages increase. And I just saw a Waymo go in front of my behind my screen. I haven't had an Uber that has a car or that has a driver in it in 6 months. Yeah. Right. And so we put all three of those things together with that competitiveness and the compounding. That's really interesting by itself. And then you add in the fact where let's talk about climate. I'm not going to talk about carbon, even though we've all tried to go on. I got to be a little bit, not too easy, don't. But you look at, I always say, you can have political beliefs, you can have all these things, but follow the money, and insurance is a great place to go, right? And you look at relative insurance, and that is a place that's purely profit driven. You look at the insurance reports and you compare the upper Midwest to Brazil on commodities. 50% of Brazilian agriculture will be outside of its climate optimal area. They'll still be able to grow, but it's not climate optimal by 2030, 5 years from now, which means we're going to have crazy bumper crops. And then you're going to have big shortages where you have to make that money. So now what you said, Evan, on compounding, it's if that OpCo that you have in those margins, you have more working capital and you have more access to capital because you're more consistent. Imagine how much easier that will be to grow than what, frankly, even you guys had in the last 10, 15 years, where it was probably a little bit more grab it opportunistically. Where am I full of shit is the question.
I mean, I just don't say all that stuff out loud, but why do you think we've been scaling? Is so that when those big years hit, there's two pieces to the puzzle, right? One is you have to have good operating margins. If you don't have that, you're not good. But I also think that the biggest issue in agriculture isn't actually fixed costs or bad marketing or logistics. It's that people don't take the time to understand opportunity cost. So you're a 2,000 acre farmer in the Midwest. You're doing really good, right? You're making your 10% margins. Things are ticking along. That's fine. Yeah, but read the book Thriving on Chaos. Sometimes your biggest risk is what you don't know. What if you could have been doing the exact same thing and making 30% margins? And then on top of that, I always say this to people is that, I love operating percent margins. It's how we do benchmarking. But last time I checked, every time I try and write a check, I can't say I got a 31% margin and they'll cash it. So they cash it in dollars. So where operating margins become really powerful is when you multiply them by lots of acres, because we live in a world where money matters. So like I said, part of it is leverage on retails. Part of it is that if we get in a point where we have to buy some land, we're going to write a check for it. And if you can't get the check or you can't get the debt, then you don't even get to be part of the game. So, I mean, everything you said kind of follows right into why we've built things the way we've built it. One is have a risk management plan that doesn't really allow us to lose money. That allows us to take the risks we need to take to maximize our op margins and do the best job we think we can. Then with that money, we need to have a strategy of how much can go reinvested into land and how much gets reinvested in the OpCo. And to be honest, how much kind of gets reinvested in our private equity arm that is twofold. One, it hopefully makes us good returns, but the other one, it forces us to learn what's coming down the pipeline because we pick specific investments for that reason. And then Jan 1 hits and we start all over again, right? But it's because of that belief that I don't believe the opportunity is changing in the next 10 years. I think the volatility is changing. That multiplies the opportunity, right? So we're living it right now in Canada. I mean, you might have to wait for climate for 10 years for Brazil and the US. We just had to wait for Trump to increase the volatility along the line. And if I'm in livestock right now, I better have a crisis management plan because a tariff hits me tomorrow. But if I'm in grain, there's different ways to look at that. I mean, my phosphate and my equipment price could go up, but my fuel and my nitrogen price could go down. And a lot of it is all timing. When am I going to buy this? When am I going to sell that? Because you should be able to use the peak to sell and the valley to buy and have some of the best margins you've ever had. But you have to have a plan, one, and two, you actually have to have time to spend watching the volatility and seeing where those opportunities are, right?
I want to pull you away from the Truth About Ag podcast to highlight one of our sponsors, Farmer Coach, the only entrepreneurial producer coaching program in Canada that offers leadership, finance, and operational training from the dirt to the boardroom. A producer program that focuses on entrepreneurial business practices and growth. An education program that links the professional services world back to the dirt and back to production agriculture. And a mass peer group of all the participants that creates a link and knowledge of both Canadian and U.S. agriculture. For more information, reach out to us at farmercoach.ca. And now back to the podcast. And I love this because he just led into my uncontrollable risk, Ben. So if you want to do a rehash here. So going back to Kristjan's line, I mean, I speak to a lot of guys across Canada when we do our public speaking as well as the coaching side. And when it comes down to risk-wise, we always look at the problem, and it's not a victim mentality, but it kind of is so, yeah, tariffs are coming in. What do? We go on Twitter, we complain, we go to Coffee Row, we tell our neighbors how bad it is, but nobody ever sits down and says, okay, what's it going to affect on my operation? And Kristjan mentioned it could affect capital, it could affect crop price. Well, what are we going to do to mitigate that risk with what we know? And maybe they don't come in and maybe they don't have the volatility, but we might as well be ahead of the curve. So maybe my capital plan gets pushed up and I buy it today instead of waiting to see what happens. Or maybe I just cut the capital plan right out for this year and assume that we're going to have a volatile year. And on crop prices, maybe I was going to wait for a certain dollar value. Well, maybe I'm going to take a little bit less today just because I know there's volatility coming. I can still make a profit. Let's close the hedge a little bit. But those are discussions that guys don't have. They're too busy looking at the things that are coming down the pipe, and the fear, whether that paralyzes guys or they just don't want to deal with it. It slows their decision making. So when we talk about the land purchases, all this stuff, there's a lot of negativity towards it, but nobody's ever sitting down and saying, what's the plan? And I think that's the difference is, especially for us, is we spend most of our time and Kristjan spends a lot of his time looking 10 years out. He's not looking at day-to-day ops anymore. Jeff handles that. He's not looking at day-to-day finance anymore. That's my job. He's looking at plans that are 5 or 10 years out. And to tell you the truth, I'm glad he's doing it because it would drive me insane because I couldn't look that far out this long.
All right, so like we've had the conversation before. I worked in mining for a bit, including close to your guys' neck of the woods, for a fairly decent stint, and like we looked at capital plans on a 10-year time horizon, all the market scenarios, all that sort of stuff. That's a lot, right? And like you guys have been doing this. I've been on I mean, even from when we first spoke 7 years ago, you're in a different place than you were then, and it is non-linear. I'm a 5,000 acre, I would say strong agronomic, still business minded farmer. What are the basic things that I need to be thinking about on the plan, and like not putting it in day one? Like what are the couple of just like quick questions that are kind of like your bellwether questions, whether it's on the Maverick Ag side or Farmer Coach side, Evan, that you have, or even just thinking about your own journey, Kristjan? Like what are the couple that come to mind if you think about kind of future proofing that, to just say like, am I on the right track or not?
Well, I'll be the recovering accountant, Heath, so you can start. Just leave me the finance piece. How's that?
I was just gonna. I mean, we got a scorecard we look at every Friday that I don't even care what my financials say because I already know what they say from the scorecard, and some of the metrics are things people can understand, right? So I mean, cash flow, and Evan can go in the details. I mean, we have some specific ratios on working capital, debt service, and debt to equity that we want to watch, and working capital ratios mean one thing, but cash flow is the other thing, and it's projected out 18 months, and we can watch that, right? So there's kind of the four pieces of the financial side. On the people side, we use that one full-time person for every 2,000 to 2,500 acres. We know that's going to cost us 1.1 hours for every acre. So our HR plan for this growing season is basically completely done already. We're not building it in June. It's done now with the part-time people, et cetera, we need it in. So people are the key part. And then the third part of that scorecard that we look at weekly is the logistics. So we know we have this many trucks that need to go in and out, and this many projects that need to happen, and who's accountable for those, and are we on track? And then the fifth one is the capital side, right? So what are the key ratios that your bank is looking at, and make sure you always knows those and you're on top of it. And what things could you beg, borrow, or steal from other industries to utilize in your industry to help that out? So, one in Canada is that in the world of real estate, really, once you get to 65% LTV, you don't have to pay principal anymore if you want. It's interest only. And yet in the world of agriculture, nobody even talks about that in Canada. But yet it can free up, millions of dollars of cash flow. And there's a big difference in separating working cap and cash flow from debt and equity and how you manage that farm. And those would be, like I said, you kind of need your own little scorecard, but that would be what I look at, every Friday to know that everything's on track.
And I mean, okay, you're speaking from a 40,000 acre farm that has internal processes and has a leadership team and a management team. So he's right. The scorecards, the up-to-date information, like all of that stuff's going to apply, the human resources. Now let's scale it back to most of the farms that I work with. The start is still the financial statements. And I hate sounding like a recovering accountant here, but know the key bank ratios. And I mean, you have a banker, it's his job to tell you it. If he's not telling you it, ask the question. Because that's the starting point is, are my financials in a position for me to do anything we've talked about for the last 40 minutes? Can I expand? Can I buy equipment? Can I pull back? Where do I look for cost of production? Like without that, we're standing still.
Well, I think, Ev, right, the one thing when Evan came on that we really pivoted to, so I mean, I always say I had good financial statements and understood it. The one thing Evan and I really pivoted to, and because Evan came on when we were quite a bit smaller than we are too, was we have the financial statements. It's the end of February. Let's meet with the bank and have all of our approvals for what might happen in the next year already done. So I knew when Evan and I went and met with the bank, I knew on February 28th of, say, this year, 2025, I could spend $10 million on land, $3 million on equipment, $4 million on buildings, and I didn't need to go ask. It was pre-approved. So instead of when land came up saying, oh, I better go ask my banker if I can get that loan, no, I'd just shake the guy's hand. I'd write him a check for $1 million, and I'd go to the bank and say we need the loan for the other 9 because we had it pre-approved. And I think for these young guys and smaller farms, that's a big difference in how you think when you already know what you can do. Then you don't need I'm at the scorecard every day just because the amount of deal flow that's coming to us. But if they know I can do this without even asking, like that's an empowering piece. When that way, all of a sudden, when you're at the local rink or you're at the local football stadium or you're at the local diner, and a neighbor comes up and says, hey, would you be interested? It's not, God, I think I'm interested, but I better check with my bank. It's like, no, I'm interested. When do you want to make the deal?
Because
I'm gonna come in here like Kristjan. I'm gonna clip the heck out of that, and I'm sending that to everyone on my entire sales list, because I think one of the biggest things that we've struggled with, like in our model, we're investing in land that a farmer owns today to take the proceeds from that to then go make the next investment. Yep. The amount of reactivity from some of the smartest farms that I knew from the software side or in the input side of the house was mind-boggling to me. And one, the plan of how many acres could you get? 2, have you aligned with your banker? And then being able to play with all those numbers around the different cost production scenarios and where it fits and where you're at in your cycle. And so the biggest thing that I always say to folks is go get that pre-approval and make sure that it fits in your kind of 3 to 5 year plan, but also just what could you do in the next 2 years? What's your working capital buffer? And for our thing, we go and we pre-approve a bunch of folks as well. And I got a list, and I can just tell the quality of just a little bit of proactive thinking. I think the toughest thing that is to observe for me has been, it's not an intelligence issue. That's for sure. It is it is an emotional change of how you approach your business. And I don't know, I've frankly gotten a lot more aggressive in just telling folks hey, your farm is going to miss out on some pretty significant opportunities if you're not willing to go do this. And I'm not saying someone like Fractal's the answer every time, but if you're not willing to at least go give that a try and see where it's at, see where the numbers pencil, if that's not worth 3-4 hours of your time, I struggle to see how that farm is going to make it in 20 to 30 years if there's not another alternative they're going.
And one of the worst things is, okay, so let's say, using your example, you're at the rink and you tell the guy, I just need to check on financing. Well, now he's going to go talk to 3 of your neighbors. Whereas if you sign the check, he doesn't go, he doesn't have those conversations, you don't get outbid. Like you don't realize how powerful it is and how much momentum you can create. The other thing, I mean, and I'll be real frank here, guys, your bank, your accountant, your lawyer, they work for you. And I think too many times we go to the bank and we put our hand out and say, "Can you loan me money?" And it's like, "No, I'm giving you the opportunity to loan me money because you make money off me. So technically you should be selling me." And often even the small guys, you still have equity, you still have land, you still have some of that power. So scale is not necessarily going to change that. It's that you have to have the confidence and realize that you're the one who's going to them with a proposal. They can say no, but if you don't have that plan up front, they have all the leverage because you're just asking for it, and they're going to give you what they feel they can get from you.
I'm going to bring up one point, and I've been lucky to have several very strong banker mentors that we have, and I think especially folks went through the 80s down in the States, and just people who think on a very forward basis. The brain drain that I heard you guys talk about, I am seeing most acutely in the ag lending sector. And the amount of strategic advice that farmers are getting, I think, is declining. Yeah. It would be an observation that even from when I came back in the industry after going to military and consulting, was like, oh, like I like my network of who I go to, like I'm calling people on the beach in Florida, not in, like in Champaign, Illinois. And I think like that is another tougher thing for these folks. And like, thankfully there's TPAP and these other programs, but like, that's not your everyday advisor.
So two pieces I would like, every farm should write down two easy pieces of advice, right? One is your banker almost every year will open up the door and say, "Hey, do you have any friends that you could refer to me? I'm trying to grow my book." Your answer back is, "I used to borrow 2 million. I now borrow 6. I plan to borrow 60. Why don't you just tell me what you can do for me and I'll triple your book by myself," right? Flip their brain to come to you with options to make their book bigger. That's point one. Point two, the first thing you should do with your bank, land backs land, machinery buys machinery, building by building, and operating should be backed by your risk management plan, your insurance, and your personal guarantee. Too many bankers just roll land to back everything. So then everyone thinks they don't have any equity to buy land. No, it's because they got $10 million of equity backing up $1 million line of credit. It's ridiculous, right? So find a banker that'll split that for you. And then that way it's your decision if you want to use a couple of quarters to back a big building purchase or a big machinery purchase, but you decided that. And then, like I said, you should know because of that, how much room do I have on my land equity, right? I'm willing to lever my land to 65%. So that gives me X million dollars of room. My machinery, I'm willing to lever to 80 or 90%. That's how much room I have. Buildings. Then if I expand, is my operating line going to go up with it? Now, if you have good risk management, your op line should go up automatically because your insurance just went up, right? But just splitting it so it's not so convoluted and you can actually have good conversations makes a huge difference in your day-to-day management.
Well, and to be fair, the low-hanging fruit, I mean, when guys start working with us, the first thing we do is ask for the commitment letter from the bank, because it doesn't take long for us to start circling things that is like, okay, this we need to fix, this we need to fix. Like, the problem is most guys haven't read the documents to begin with. As Kristjan said, they've had land on an operating line of $1 million for 10 years, and now that land's worth 10 million. And the bank, of course, guess what? They're not going to be the ones coming to you to tell them to give up security. Trust me. That's one thing you're not going to hear from your banker. So you need to be proactive in actually taking that route of understanding where your security is locked, what it's covering. And if your bank's not willing to come to you and bring proposals, like we've learned now that we tell the bank at our meetings, I want you to bring something to me. I don't want to be the one bringing stuff to you every time. You actually have to provide value, because that's what a bank is. They're providing value and they're providing lending. And if they're not doing it, that really makes me question the serviceability, and maybe I'm at the wrong bank.
Well, we've went to the point that we send them a 2 or 3 page proposal, 2 weeks before the meeting to say, this is what we're coming in and asking for. And it's a fine line between an ask and a demand. So we hope you bring back solutions that work within your rules to meet our requests, right? Like, and then that way the first meeting's not a waste. Like, it's unbelievable how fast stuff can move in an industry that typically doesn't move very fast.
Well, and you're figuring out their limits, and then you can help out, right? And it's that partnership that we talked about before. So nobody has you by, whatever metaphor you want to use, but you're still working, both with the individual and the institution, you're able to work within that because they have risk management. You're not asking them to bend that. You're saying, how do we create the win-win that exists.
Yeah.
Yeah.
I guess if I just sum up kind of where a lot of this stuff is at, because I know we got to wrap it up, and I am the anti-professional podcast person. I was sick of hearing you guys just give each other softballs, so I wanted to kind of at least get a little bit more and not that maple skating stuff that I hear every time I listen to you guys. But it's I think there's always the proactivity and there's the planning, and obviously you guys have spent a lot of time, and I think you can't spend more than a half hour with either of you and realize how compounding the learning and knowledge is. I think sometimes it's intimidating to listen to. Like, I came from a management consulting background from a very well-known consultancy. And I remember listening like the first time being like, what the hell are these guys talking about? But the element that I keep coming back to in this is just like the basics on financials, knowing that, being proactive with all the levers, not being a zero-sum person, and not saying no to opportunity. And so we talk about, obviously I have a vested interest in folks that are asset heavy. I believe I built a whole business around wanting farmers to do that because I believe it was in their best interest, but also being able to say, when does renting make a heck of a lot more sense? What are those relationships? Being open to that. How do I manage risk across the board? So I appreciate how you guys kind of bring all that together. I got a couple of just rapid fire things for you. So none of the normal long answers that we're known for when it gets super cold. And I know it was, -40 or something up there. Autonomy. What does that do to farm competition and just this whole conversation?
Am I going first? Yeah. So, I mean, I think I'm big on autonomy on peripheral activities right now, not on your key ones. So seeding, spraying, and harvest, I think are going to stay fairly operator based, but don't get me wrong. The autonomy side of the settings, et cetera, has made it way more trainable for us. Things like, rock picking, harrowing, rolling, all those secondary activities. I think autonomy, AI and autonomy are going to completely change the way we do it. And I don't look at it as I'm going to get rid of all my people. I'm going to, my people are going to be able to cover twice as much of the land because of autonomy and AI as they do now.
What happens when you can cover twice as much of the land in the conversation we've had?
Well, my fixed costs go down and I can move faster.
Okay, so if the Heber groups can move faster and so can the random farmer in Iowa, like what does that do to the market?
Well, we got how much land do we got to take over by 2033? We got to move fast, right? And I think this goes back a little bit to your 5,000 acre guy that's about to lose a third of his farm, and he's in that. One thing to remember is if you're going to overpay to a local or a family member where you can get first and last right of refusal, because really you're overpaying for control. Don't overpay to some person that's never going to sell that land in their entire life, because then you're paying rent and you're paying a put option, right? And if you have that option, then you have people that you can work with. I'm not trying to throw you a softball, that if it ever comes for sale, you have the ability to get control of it, or at least a portion of control. Like there's a big difference there between way overpaying cash rent just to be able to farm that land for a little bit. There is a difference when you pay for control for some options, right?
And I would second the autonomy part is I don't see it taking all the people out of agriculture. So if that's your plan and you think your labor plan is going to be autonomy, I would probably look at that a little closer, because even the forms of autonomy, we're starting to see smaller rigs, a whole bunch in the same field. You're still going to require the labor component, and specialties are never going to be replaced by AI or autonomy. Thought leadership is never going to be replaced by AI or autonomy. So you're still looking as people as your number one asset, even if you're going to invest in automation.
I think, especially in areas that are more fragmented now, I think what you'll see is competition will increase. That marginal rent will continue to go up, because what happens? I mean, look at all the Trump, in the U.S. where we have a lot of generous government support. All that just goes into land values, right? Pure commodity, like where it goes.
100%.
It's the essence of agriculture. Let's be fair.
Yeah, and where it goes. All right, so we hit autonomy. Do you want to hit carbon, Kristjan? I know I saw you tweet about it the other day. Like, is carbon dead? Is there? Let me ask this: we're seeing a shift rightward and a shift away from ESG mandates, both in a corporate setting in many cases, and then in government mandates. Is this a temporary thing, or are we still need to be going down that route? And like, where does that fit in risk management, and kind of where you're prioritizing your time and resources?
And the division between U.S. and Canada.
Oh yeah. So I'd follow your comment on follow the money and follow insurance and follow financials, right? The ship sailed on carbon, ESG, et cetera, is going to be important in the next decade, whether I want it to be or not, because there are billions and trillions of dollars behind it. Are we going to see Are we going to see the craziness of the left side of carbon slow down? Absolutely, right? But one of my most interesting stories is we did a bunch of acres on the NERP protocol, so nitrogen emission reduction policy, which has been around for 30 years around the whole globe. And in the U.S., you can actually take your nitrogen emission reduction through good farm practices, and a company can buy that from you and directly take a scope 1 emission deduction. And I don't think scope 1 is going anywhere. I think scope 3 might slow down, which is scope 1 is your actual business. I don't think any farmers have a problem with a large fuel manufacturer, a large fertilizer manufacturer having to buy some carbon credits from them. Scope 3 is where now they have to care about their customers, which now we have those big companies telling us what to do. The neat thing is the U.S. in general has said, we don't so much care about carbon and ESG, but in the U.S. you can do a direct reduction on scope 1 with NERP protocol on a farm. In Canada, we're around the world telling everybody we're the best at it and we want to do it as a government. And in Canada, you can't do a deduction from the NERP protocol against scope 1. So I would say one thing is everybody that's been hearing about this can quit dreaming about what they're hearing, because the U.S. is way farther ahead than Canada on carbon and environmental standards because the money is doing the work. They've let the money get the protocols in place. I think the ship has sailed. And the reason I'm a little bit pro about it, and I say this to every big company I talk to, I'll believe that you care about carbon and the environment when you start writing me checks, not white papers. Because we're a little bit lucky in Western Canada, right? The number one protocol, doesn't matter what you read, regenerative, et cetera, is zero till. I farm around the original zero till plant. Like, we've been doing it since the late 80s. So big companies that want to put a bunch of money in this in government, I'll believe you care when you start writing me checks for zero till. And until then, quit writing white papers.
Well, in North Dakota, we'd say you're a late adopter if it was the late 80s. So, yeah.
Yeah, that's right. That's right.
And I mean, on the planning stage of that is if you have data, keep the collection right, because I still think it's coming down the pipe. You might as well have it in place and be an early adopter to get that check. Because anybody who just wants to put their head in the sand and say it's not coming, that's fine. You're just going to miss out on money that probably should be going into your bank account.
Yeah. And I think the only other thing I'd add, obviously, I mean, North Dakota guy who lives in San Francisco ran a carbon program, yet still is, you wouldn't be able to guess which way I vote on a given thing. The big thing for me is risk management in the long run. And it's not actually to me about, the data is important. I agree with you completely, Evan. It's the agronomy. I start and end with agronomy on it and where the ROI is, and getting those learning reps in at a smaller scale. So if there's a forcing function, my wife is half Dutch. So I'm back in Rotterdam talking to a bunch of farmers in the area and what they're being forced into. And that is not manageable risk other than policy engagement and all that. But do you really think are you going to bet your family legacy and your business on that? No. So learn how, can you figure out if there's a forcing function, what to do, at least at a small scale, so you're able to kind of future-proof it. Anything else we want to cover? I know we're already way over and I suck at this, but I enjoyed the conversation.
I don't have anything else, Ben, and honestly, I knew we'd be over because with us three on here, I was expecting it. So
cool. Well, I appreciate you guys giving me a chance to just ask you a bunch of questions that I've been wondering while listening, and bring some of the conversations we've had over the last couple of years to light. And yeah, appreciate, I guess anyone, I'd say the thing we haven't talked about on the scaling piece is that advisory side and getting that learning both from other areas. And so as somebody who primarily works with the Iowa, Illinois, Minnesota, kind of left the prairie, I think there's a lot to learn from you all, both on the professional side and just from the content. So appreciate the time, guys.
You betcha. And my last line, I want to obviously plug the Truth About Ag podcast. So if you're one of Ben's listeners and not one of ours, please subscribe, like, comment, join the club. Eves, you got anything to finish with?
Yeah, no, I mean, it was fun. And I think when it comes to advisory or scale or anything, the number one thing is figure out what you're good at and figure out what you need to hire people around you to be good at, whether that be full-time people for you or advisors. I mean, we know some really good accountants and some really good bankers and some really good lawyers too. So you have to surround yourself with people that are really good at the things that you don't have time for or you're not good at. And that's the easiest way to move fast. And we kind of encourage you, right? Build your business like a sports team. And honest to God, that it is that simple.
All right, gents. That's the Truth About Ag. Thanks for joining us. The Truth About Ag podcast is a proud member of the Heber Group, which includes Heber Grain Ventures, Maverick Ag, and Farmer Coach. We appreciate the support. Lastly, please like, comment, share, subscribe, and ring the bell. And if you have questions for a future podcast, please leave in the comments below. Thanks for listening.